All right. Well, we're at 2 o'clock East Coast time, and we're ready to go ahead and start with our webinar with regards to potential COVID impacts on your company retirement plans. Today, we do intend to talk strictly about your DC plans, 401k and ESOPs in particular. We have a group of panelists with Blue Ridge who will be helping present this today. My name is Randy Shrake, and I'm a director with Blue Ridge. And I'm going to be kind of hosting this and kind of emceeing the questions at the end. Since we do have a lot of information to kind of go over, as I mentioned earlier, we do intend to stick around and answer any questions you might have until we run out of time. Any questions that we are unable to answer while we're live here, we will definitely take down, and we will supply a Q&A to go along with the recording of this presentation. So don't fear if we aren't able to get to your questions, we will do our best to answer them for you. As I mentioned, everybody here is also on mute. Unfortunately, with this particular software, we're not able to unmute everybody because of the number of people that are here. So there is a Q&A box at the bottom of the screen. If you have a question as we're going through this, please feel free to type it in, and either I can try to answer, or we'll ask the panelists during their part of the presentation, or we'll answer it as we collect these for the end of the presentation. So today, presenting with us is going to be Gary Gurman, Scott Freund, Renee Statmuller, Kevin Rush, Carla Klingler, and Dolores Lawrence. And with that, I'm going to go ahead and turn this over to Gary.
Okay, thank you, Randy. Good afternoon. Hope everybody is doing well today. On March 27, 2020, the CARES Act was signed into law, which provides temporary relief for participants in a qualified retirement plan with special loan, distribution, and required minimum distribution options through the end of 2020. As I cover these new provisions, please keep in mind that adoption of most of these provisions are optional during this period. The special provisions are generally available for most defined contribution plans. However, even though the new required minimum distribution rules will apply to 401ks and ESOPs, the special loan and distribution rules are perhaps better adapted to 401k plans where liquidity of participant accounts is easier to accomplish and distributions can be made fairly quickly. Additionally, the CARES Act does allow the Department of Labor to waive deadlines for filings and disclosures, but there is no action on this yet. As of now, if there are required filing and disclosure deadlines in the near future for some off-calendar plan years, then these need to be done on a timely basis. There are currently no exceptions. The changes we're going to talk about first are with respect to required minimum distributions, which the IRS waives for all of 2020. And this includes required minimum distributions that were made for the 2019 tax year in 2020. So if there were required minimum distributions processed through April 1, technically these are waived. We're going to come back to that. Also, there is a waiver of a plan or IRA beneficiary that is receiving distributions over a 5 or 10-year period, and these also get waived for 2020. So let's talk about if a required minimum distribution had been processed earlier in the year before the CARES Act became law. So under the CARES Act, those prior required minimum distributions are now eligible rollover distributions. They do not need to be included as taxable income only if those were processed within the last 60 days. So if a 2019 required minimum distribution had been processed on March 1 of 2020 and is now within the 60-day rollover window, that prior distribution can be rolled over to an IRA. But what if there was an earlier required minimum distribution that was perhaps processed on January 15th of 2020 that is outside of the 60-day rollover period? Right now, under current guidance, there is no ability to roll that amount over to an RMD. However, we are expecting further guidance from IRS. We do need guidance, and we did have a similar situation about 11 years ago in 2009, which allowed for extended periods to roll over required minimum distributions that had been processed before the special rules took effect. So we hope to see those types of changes. Now, I'm going to talk about the special loan and the special distribution and loan provisions that are in the CARES Act. So we go to the next slide, please. And when we talk about special loans and distributions, this is specifically for qualified individuals. And a qualified individual in a plan is a participant that has a diagnosis of COVID-19 through a test approved by the Centers for Disease Control and Prevention, also known as the CDC. This would also include the spouse and dependent of the participant who is also diagnosed with COVID-19, and also situations of adverse financial conditions due to a furlough, layoff, quarantine, reduction in work hours, or the close or reduction of a business related to COVID-19. And the qualified individual is able to self-certify that they meet one or more of these following conditions for the special loan and distribution provisions. There appears to be no requirement to present proof or other documentation to the plan sponsor. So let's talk about the special distribution provisions. And these are in effect for the remainder of the year. And a participant who meets one or more of the qualified individual requirements can take a tax-favored, penalty-free coronavirus-related distribution of up to $100,000 for the remaining portion of the year. And when we talk about $100,000, it's not per plan. It would be for all plans that the participant, the qualifying individual participant, is a member of. So if the participant has a 401k and is perhaps a participant in another 401k plan or has money in an old 401k plan and also perhaps an IRA, then the $100,000 special distribution limit is for all plans, all IRAs that the participant has access to. Now, there's also a provision that the distribution can be repaid either to the plan from which it was taken, if the plan allows for rollovers. So if a distribution, let's say of $30,000 is taken, and at some point that the participant wants to repay that distribution, they can over the next 3 years. They can repay a portion of it, they can repay all of it. Also, the distribution can be included as income proportionate over a 3-year period. So let's look at a quick example, $30,000 distribution, 10,000 of it can be included as ordinary income for 2020, 10,000 for 2021, 10,000 for 2022. If any amount is repaid, and we need IRS guidance on this issue, then income, any amounts that were previously included as ordinary income, presumably would be able to be reclaimed. However, the participant may need to amend a prior tax return. Other special considerations are that there is no 20% mandatory withholding. However, the 10% standard withholding rate for the distribution would apply unless the participant elects no withholding or a different rate of withholding. And also, there is no special tax notice required either. Okay, next, there are special loan provisions also allowed for 180 days from the date of the CARES Act, and that would end approximately September 23rd of 2020. So between now and 2020, the plan can also permit a special increase of the loan limits. Currently, the loan limits are 50% up to $50,000 of vested account balance, but under the CARES Act, a participant, if permitted, would be able to take an increased loan of 100% of their account balance up to a limit of $100,000. Now, the special rules are not meant to replace existing loan regulations. So if there are existing limitations on loan, for example, the plan only allows for one loan, and the participant has an existing loan, then they're not going to be able to take an additional loan or an increased loan under current plan rules. But however, the plan could be amended, the loan rules adapted to allow for additional loan or refinancing of a loan to take advantage of the special increases. Now, there's also another provision related to loans that allows for a 1-year delay of loan repayments that are due in 2020 until the end of the year. So even though the new increased loan limits expire on September 23rd, any loan payments that are required between now and then the end of the year, and again for a qualified individual, these loan payments can be delayed for up to 1 year. And that could mean effectively a 5-year loan could now be extended to a 6-year loan possibly. And if there is a delay, if there is a hold on those loan payments, then when loan payments resume, then any accrued interest during the time that the loan was not repaid now have to be amortized over the remaining term, and the loan would generally need to have increased payments or changed payments in order to be repaid over the extended term. Okay, next page. I'm sorry, I jumped ahead, pardon me. Okay, so now let's talk about the effective date of the plan changes. So plan amendments for the coronavirus-related distributions, the required minimum distribution waivers, increased loan limits, and again, they're all optional, would be required by the last day of the plan year beginning on or after January 1, 2022. Now, we've pretty much reached the end of the CARES Act review for this part of the presentation, but before I turn it over to Scott and Renee, I would also like to mention that if any of these provisions are adopted in part, or if all provisions are adopted, then your investment platform vendor must also work with us and with you as the plan sponsor to implement these provisions. A number of plans have already received information and forms from their investment platforms with different approaches on how to implement the special provisions for 2020. If you have any questions on how to complete the forms or which provisions to apply, please discuss with your Blue Ridge admin specialist and we can help you. So thank you very much. I hope everybody stays well. And I will turn over the presentation to Scott and Renee.
Okay. Thank you, Gary. Again, this is Scott Freund, and I'm happy to spend the next couple minutes speaking with everybody regarding some potential compliance testing and vesting impacts that this COVID-19 pandemic might have on your ESOP and or 401k plan. So if we go to the next slide, the first item that I'd like to discuss is what's known as a partial plan termination. So a partial plan termination can occur if the amount of employer-initiated or involuntary terminations of employment amongst your employees that are participants in your plan is significant. The presumption of what a partial plan termination is if the amount of involuntary terminations that have occurred amongst your active participants in your qualified plan, if that percentage of active employees who've terminated is greater than 20%, it is presumed that a partial plan termination has occurred within your ESOP and or 401k plan. So what's the impact of that? The impact is that if a partial plan termination occurs, any participant who's affected by that partial plan termination has to be made fully vested in their account balances as of the date the partial plan termination happens. Now, specifically, when we're doing this partial plan termination analysis, it is typically done over the course of a plan year. And this is a process that your Blue Ridge ESOP Associates administrator does as part of their normal administration process. So when we go through our normal year-end process, we will take a look at your total number of terminations of employment, and if the initial pass is greater than 20%, that's what triggers our staff to reach out to you and provide you with a list of everyone who has terminated so that you can provide further information on whether those terminations are voluntary or involuntary. That would then allow us to assist you in determining whether or not a partial plan termination occurs. Now, specifically with respect to our employee stock ownership plans, a partial plan termination can be expected to result in an increase in your repurchase obligation. For one, you're going to have more employees who've terminated who may be eligible to request a distribution from the ESOP based off the rules of your distribution rules, and those employees who have terminated are now fully vested. So specifically, the portion of their account that was non-vested no longer is. It's important to note as well that though when we look at involuntary terminations for determining whether or not a partial plan termination occurs, the actual affected participants who have to be fully vested would be anyone who terminates employment during a plan year. So it does trigger full vesting amongst all of your terminated participants in a plan year if a partial plan termination occurs. An important distinction too is that when we look at this test, we're looking specifically at people who have actually separated from service and who have fully terminated employment and are no longer employed as of the end of the plan year, which would be the typical date that we perform this analysis. So if you have employees who are on a short-term leave of absence or potentially are being partially paid through a furlough or a short-term layoff, in general, we wouldn't expect that specific population of employees to impact your partial plan termination analysis. Really, the analysis is going to trigger those employees that you have severed from employment. You've given them a termination date. They're no longer employed, receiving compensation or benefits, and are reported to us at year-end as a terminated employee. So it's important to understand that that is something that we will have to pay close attention to you with, and that as part of the annual process that we'll work through to help you identify whether this partial plan termination occurred. Next slide. So next, one of the specific compliance tests which may be impacted by the COVID-19 pandemic would be something that we call our coverage test. The coverage test is required to ensure that the number of employees who receive a benefit within your qualified plans is not discriminatory in favor of your highly compensated employees. Generally, what we do is we take a look at your non-highly compensated workforce and determine the percentage of those non-highly compensated employees who receive a benefit within the plan who are participants. We compare that against your percentage of highly compensated employees who are participants in the plan who receive a benefit. As long as the percentage of your non-highly paid group who get a benefit is greater than 70% of the percent of your highly paid group who receive a benefit, this coverage test is deemed to pass, and you're good. Where the issue comes into play is with companies that have high turnover. Specifically for a lot of ESOP companies, you have contribution formulas that typically require an employee to be employed in the last day of the plan year in order to share in the allocation of any company contributions and ultimately receive a benefit for that plan year. So to the extent that you may have greater turnover than usual, you may have a smaller percentage of participants who benefit in compared to prior years. That could be a potential factor in causing this test to not pass. Now, to the extent that we're not able to show compliance with this test through any sort of other various optional compliance testing considerations that we would work through, it may require you as a company to expand the population of your non-highly compensated employees who normally would benefit in order to get that percentage of employees up to the 70% level that would show passing of that coverage test for the year. So to the extent that you have significant terminations, it may require you to expand your population to employees who typically would not be contribution eligible for the plan year. I think it's important to note that a lot of companies already have what we call fail-safe provisions within their plan that specifically goes through this process and identifies that to the extent that you do not pass a coverage test, it goes through the steps as far as which employees you would then provide a contribution benefit to allow you to pass the test. So it's important to take a look to see whether or not you have that provision in your plan. And if you don't, you may want to consider discussing that with your ESOP attorney to determine whether or not you want to consider a plan amendment to put that fail-safe provision in your plan. It is also an amendment which can occur after a plan year end. So it is one of those few amendments you can do to your plan on a retroactive basis, but there's additional considerations you have to do if you want to do that. So I'd encourage you to reach out to your counsel or your Blue Ridge ESOP Associates administrator if you have any concerns with the coverage testing. Next slide. The next item I'd like to discuss are the contribution deduction limits. These are limits that any qualified retirement plan, specifically talking about defined contribution plans, that are subject to as far as how much you as a company can contribute to your ESOP and or 401k plan as a deductible company contribution. That limit in general is 25% of eligible compensation amongst your employees. The limit is expanded for those companies out there that are C corporations and currently have a loan outstanding. Those leveraged C corporation ESOPs are subject to a potential additional deduction limit, specifically with reference to the loan payments that you're making on your ESOP loan. But for those S corporation ESOPs out there listening to the presentation today, your limit is the 25% of compensation limit. And this isn't a limit per plan, it's a limit in aggregate. So if you have both an ESOP and 401k plan, the total amount of contributions that you can put in all plans can't be in excess of 25% of your total eligible wages in your ESOP and 401k plan. That would cover not only any loan payments that you're making on your ESOP loans, it would also cover any cash that you contribute to the plans for funding of distributions, or any matching contributions or discretionary contributions that you're making to your 401k plan. Those are all the types of employer contributions that are subject to this limit. Now, specifically, if you have employees whose salaries have been reduced due to the COVID-19 pandemic, or you have a reduction in workforce, so you have less participants that are eligible to share in company contributions, that's going to reduce your eligible compensation and potentially have an impact on what your deductible limit is in this coming year in comparison to prior years. I think in specific, those companies out there that are highly leveraged ESOPs that push up against the 25% of compensation limit to be able to fund your annual ESOP loan payments should in particular pay very close attention to this because it could cause some testing considerations with respect to your allocations for this upcoming plan year. There are some options available for how you can fund some additional ESOP contributions if you feel you may have an issue with reduced eligible compensation. One option that's available is for any ESOP funding requirement, it is possible to also pay dividends, or for your S corporations, technically called an S corporation distribution of earnings. Those dividends or S distributions are not contributions, they're earnings. Therefore, those dividends are not subject to the 25% of eligible compensation limit. So it is possible for you to utilize dividends or S distributions to help with some of your required funding, whether that be for loan payments or funding a repurchase obligation. For those companies that have historically been making cash contributions to your ESOP to fund distributions to your former employees, you may want to consider whether it's appropriate to process your distributions in the form of stock, which would allow you to distribute shares to your employees and redeem those shares rather than making cash contributions to your ESOP to fund those distributions and recycle those shares within the plan. Any redemptions that occur directly by redeeming shares from employees are not contributions to the plan, and they wouldn't be subject to the 25% limit. As a worst case scenario, if you could potentially also discuss with your ESOP counsel and your trustee, if you utilize an independent outside trustee, whether or not it would be appropriate or considered to modify the terms of your internal ESOP loan between the company and the ESOP. Under some very limited circumstances, it is possible to do a refinancing or modification of your internal loan. It's something that requires careful analysis and consideration, and your trustees will typically ask for additional inducements if that's something you'd want to consider because you feel you don't have enough compensation available to fund your loan payments. It's important just to know that that is something that you can consider and that you may want to discuss with your other professionals if needed. So we can go to the next slide, and I'll turn this over to Renee.
Thanks, Scott. So the final test that we're going to talk about today that may be impacted for your ESOP is the anti-abuse testing, or 409P, you may hear it called. I won't get into too many details of how that test works, but basically, just to give a high level to see how this is impacted, the test checks to make sure disqualified persons do not own more than 50% of deemed owned shares. And a disqualified person is anyone who owns over 10% of deemed shares. So how does this come into play, and why would it matter in times like this? Deemed owned shares also include synthetic equity, and there are a few forms of synthetic equity that are actually based upon stock value. We're going to talk a little bit further about interim valuations, and maybe you might be having an interim valuation, or you might anticipate next year's stock value is going to decrease significantly due to everything going on in the economy right now. And so the main example I could give for this would be deferred compensation plans are considered synthetic equity for this purpose. So as we know, that's really a dollar value, a deferred compensation plan. What we have to do is actually convert that to shares to get the number of deemed owned shares. So I'll give a quick example. If you have, say, $100,000 in your deferred comp plan for one particular person, and your value is $100, that means that is in effect 1,000 deemed owned shares for that person. But if your value would be cut in half to say $50, that already takes that person to 2,000 shares, which could in fact make them a disqualified person. And if you have too many of those situations, or that person by itself goes over 50%, you will not pass 409P, which is really not even an option. So this test is run every day. It's unlike the other tests we do that are typically done at year end. The 409P really has to be passed every single day of the plan year. So it's really important in this case that you're doing some pre-planning or projections to make sure, if you have these type of synthetic equity arrangements, to make sure they're not going to cause issues for you in the upcoming year or years. If you do think you have a problem with that, I definitely suggest you reach out to your administrator and they can work on some projections for you. We could figure out, you know, if the stock decreases by X percentage, what does that mean, or those sort of things. And that's something we do regularly, so would be no problem. The other thing that you'll want to do is also take a look at your synthetic equity arrangements and your plan document, because most of those type of arrangements, they may already have a cap, a 409P cap in them, which will prevent you from failing the test. And the plan document often has language what to do if you do have a potential 409P failure. So you'll want to make sure that that language is in your document. And if you have trouble finding that or want to talk about it further, you could also reach out to your administrator. I think next we're moving on to valuation considerations, and Dolores will take over.
Okay. Okay, this is Dolores, and I want to start first by saying I am not a valuation expert, and I'm not an attorney either, but I am still going to talk about valuation considerations, and in particular in interim valuations. Next slide. Again, most ESOP documents that we see provide that in addition to your plan's year-end valuation date, the plan administrator for your plan can select other dates as plan valuation dates. So this provision in your plan gives you the option to update participant accounts if there is a significant change in plan asset values. So if, for example, your plan year end is 12/31/19, and there's a reason to believe that there has been a significant reduction in the company share value, and that change is expected to last for a period of time, then you may want to consider completing an interim valuation and updating participant accounts for new values before paying distributions. Now, the decision to have an interim valuation is a fiduciary decision. And in making this decision, you do need to think about, well, have we ever done this before? Did we do this during the 2009 downturn? Have we ever set any previous benchmarks or triggers for having an interim valuation? So certainly the discussion on having an interim valuation is something that you're not going to do in isolation. You're going to bring in your valuation experts, your trustees and legal counsel to discuss this decision, weighing the impact on all participants, both your active participants and your terminated participants. And then you will need to document your decision so that you've kept a record of what considerations went into this decision and that you made the decision in the best interest of all participants. If there is not interim valuation date language in your plan, it could be added now by plan amendment. However, it may not be possible to then have an interim valuation and make distributions based upon this new value to people who had already terminated and lined up before the valuation to be paid. That would be something to discuss with your legal counsel. Now, I know we've been asked if there was a bright line or a bright test for determining whether we should have an interim valuation. And the answer is no, not really. One financial expert was sticking out his neck recently and suggesting that you at least consider it when you have an estimated share price drop of 10% or more. I don't know where he got the 10%, but at least he was willing to throw a number out for consideration. Another expert suggested perhaps a 20% drop would be a good guideline for considering an interim valuation. But again, there is no legal bright line. There's no one size fits all for every company. Next. Okay. So again, there have been some good webinars on valuation issues just in the last couple weeks. The ESOP Association had a webinar on valuation issues on March 27th that really dug deep into the whole question of interim valuation. So if you are a TEA member, you may be able to obtain the recorded version of that webinar. And the Beister Institute also had a similar webinar. Recent webinars have emphasized that, next slide. Recent webinars have emphasized that, no, let's go back one, that if you've already had your, let's say your plan year end is 12/31 and you've already had that stock appraisal done, that value stands. You can't go back now and say, well, my 12/31 value should be lower. It's based upon the facts that were known at that date. And even if you haven't yet completed your 12/31/19 valuation for a 12/31/19 year-end plan, we're still told it would have to be done in that same manner, based upon the facts and circumstances that stood at that date. So that's another reason to consider an interim valuation, so that a new value would reflect the facts and circumstances on a different date. So perhaps for a 12/31 year-end plan, you might consider an interim valuation date of March 31 or April 30th. Appraisers are telling us that if you do have an interim valuation, they will need to perform a whole new appraisal. They'll need all new financial data and projections from you. So you may want to consider before pulling the trigger, can I come up with reasonable projections now based upon the uncertainties that exist now? Also consider that if you do have an interim valuation, you're setting a precedent for your future actions, including possible future dates at which you might want to say an interim valuation is needed. Now, we know if you have a September 30th year end, you're probably saying, well, I've got very little time to have an interim valuation done and hold participant statements and then pay people out. So that's something you could discuss with your advisors, whether you do have the time to actually get this done or whether you need to come up with some other magic solution to dealing with your perceived or known stock drop. Next, again, if you're thinking about this interim valuation and you really have not made a decision, you may want to hold those participant statements even if the work's done. You may want to delay sending out distribution mailings while you make this decision on a special valuation. Or if you want to go ahead and send the statements out now, you may want to put something with those statements that say, this value as of 9/30 or this value as of 12/31 is based upon the work that was done by a qualified appraiser based upon the facts that were known as of that date. So again, there are certain considerations with doing this, cost considerations and time considerations in having a special valuation. Okay, I think I'm ready to turn it over to Kevin to discuss distribution issues.
Thanks, Dolores. One question I've been getting quite a bit the last couple of weeks is how can we process these distributions not knowing what the new valuation is going to be if we're getting an valuation. And there's really key parts of ESOPs that you got to look at for distribution processing. One is diversification, and the other is just processing your standard ESOP distributions for people that terminate due to retirement, death, or disability, or regular termination of employment. Next slide. We wanted to share some ideas with you today about how you can satisfy these requirements, following your plan document, and also being able to get money to participants as soon as possible. And with diversification, if you're not familiar with that provision, what it is when a participant has been in the plan for 10 years and they've reached age 55, they can diversify a percentage of their account balance over a 6-year period. And in the first 5 years, it's 25% of pay on a cumulative, 10% of their account balance on a cumulative basis. And in the final year, it's an additional 20% for a total of 50% in that period of time. And your plan document will dictate how the participant is notified of their eligibility. Some plans will say that you have to notify them the first 90 days of the plan year that they're eligible so they can make an election, and then you have another 90 days to process the distribution. But that can be very complicated for a lot of plans to do that because many clients don't get their valuation until after the 90-day period has expired. So you can't tell them what the value of their account is and what the share value is in the 90-day period. But good for us, in 2015, the IRS issued an LRM that had said that you can extend that 90-day period to be 90 days from the time they get the updated stock valuation, so the day that you hand out your participant statements. So if you put that in your plan, it may be already in your plan. If it's not, you can amend to have it in your plan. That'll give you more time to notify participants that you're eligible to diversify and still meet the qualification requirements of what your plan says you need to do. Like Dolores had said though, if you're going to put this in your plan, we'd highly recommend not sharing the 2019 valuation until you have the interim valuation done. So you can share with them at the same time, here's your 19 account balance, but here's your updated interim valuation balance that we're going to use for processing the diversification. And now you have 90 days to make your election based upon the information in front of you. Next slide. The other key component is distributions. And your plan document will define how distributions are paid out of the plan. Are they paid lump sum, installments, stock or cash, immediately or delayed a couple of years. And you probably have a separate distribution policy as well that'll indicate, even though my plan says I can do all these different options, we are going to do this thing at this point in time. For example, your plan may say you can do lump sum or installments, but your policy says we're going to do lump sum distributions, which is more liberal than what your plan document allows for. So this is an opportunity to look at what your plan document says and what your distribution policy says, and possibly amend your policy to allow for spreading out those payments over a period of years, delaying that first distribution if you need to. And you may have some plans are written where the policy is right in the plan document. It's not a separate distribution policy. Look at what your plan says and maybe work with your attorney to amend your plan document, because you can change your plan document to stretch out your payments or change from lump sum to installments as a way to help with the company cash flow in this time of the year. In addition, a lot of plans will say, we're going to force out small balances. If your balance is $1,000 or less, or $5,000 or less, we're going to pay you a taxable distribution for a balance of $1,000 or less, or roll over your balance to an IRA if it's between $1,000 and $5,000. If you got a number of participants that fall into that category, that could add up quickly to be a very large number. You could amend your plan to remove that provision for the time being, so their funds stay in the plan as opposed to being paid out in this 2020 plan year. One thing that we've been hearing from clients too is we still want to keep on paying lump sum distributions, but we also want to look at getting an updated interim valuation. What can we do to get participants cash now without potentially overpaying them their account balance, because we don't know what their balance is going to be once we get this interim valuation. And one suggestion that's been passing around the industry is looking at doing a partial distribution. For example, paying out 50% or 60% of someone's account balance now based upon their 19 valuation. And then once you get the interim valuation later this year, then pay out the remaining account balance that's due to them. The big caveat there is you gotta be careful you don't pay out too much the first time, because if that interim valuation comes in lower than what you paid out initially, you don't want to end up overpaying someone their vested ESOP account balance. So that's a consideration. Still paying some of the balance now, but then paying the rest of the balance later this year once you have a better idea what their account balance is worth. And then last but not least, whenever you're making changes to your distribution policy or your plan document, always look at what the impact is on your repurchase obligation. It's amazing changing from a lump sum to an installment payout provision, what impact that can have on your plan 3 or 4 or 5 years from now that you wouldn't be thinking of unless you have someone help you with that analysis. And a lot of clients do their own studies. They might have software that they use. Some clients hire us to do purchase obligation studies. We'd be happy to work with you on that. But just always consider looking at what changes are you making today that can impact your plan 4 or 5 years from now. And that can be fine-tuned by looking at a repurchase obligation study. Next slide.
Okay, Kevin, I assume you're done.
Yes, thank you, Gary.
Oh, okay, good. Thank you. Okay, I'm Gary Gurman again, and Renee and I are going to discuss how to conserve corporate cash through your retirement plan during these challenging times. The methods I'll describe are not part of the CARES Act. Because the CARES Act only provides the special loan and distribution relief, we are relying on current IRS regulations until we perhaps get further guidance in some of these other areas. The options I'll describe are generally available for all defined contribution plans. However, I will address the options within a 401k plan or the 401k portion of a KSOP. 401k plans or profit sharing plans that have a 401k provision have either fixed contributions or discretionary contributions. The end result we are looking for is how to reduce or eliminate employer contributions where needed in these types of plans. Let's look first at a plan with fixed contributions. This could be a 401k plan that makes contributions at a stated rate, for example, 50% of 401k contributions up to a deferral rate of 6%. Or perhaps a safe harbor match or safe harbor non-elective contribution plan. The plan document determines the rate of contribution for the year or until there is an amendment to reduce or eliminate the match. If the plan is providing a regular match that is not a safe harbor match, the plan can be amended to reduce or eliminate the match prospectively at any time during the plan year. If the plan document requires the match to be calculated each payroll, then the amendment can provide that the match will stop, for example, as of the last payroll date in April. If there is an amendment to change the match formula, it is going to be best practice to communicate the change to eligible employees as soon as possible so that changes to deferral elections can be made coincident with the plan change to reduce or stop the regular match. If the plan provides a safe harbor match or safe harbor non-elective contribution, the plan can also be amended to eliminate the safe harbor provision before the end of the plan year. There are a few additional requirements to make this happen. Number one, there is a minimum 30-day notice requirement to eligible employees so that they are aware of the elimination of the safe harbor match or elimination of the non-elective contribution. Number two, participants are given the opportunity to change their deferral elections at least during the 30-day period. Number three, safe harbor contributions, whether they are match or non-elective, are required to be made up to the amendment date of the plan. Number four, with the elimination of the safe harbor plan requirements, the plan must also test for non-discrimination. And that would be the typical ADP-ACP test. If there are excess contributions for highly compensated employees as a result of the test, then the excess contributions must be returned timely and are included as income. If the plan has all discretionary contributions, then no amendment is required to reduce or eliminate ongoing employer contributions. For example, if the plan is providing a match of 50% of 401k contributions, like in our earlier example, the match can be stopped at any time. Because the match is discretionary, there are no other special requirements. However, it is again best practice to notify participants as soon as possible regarding the change so that salary deferral elections can also be adjusted. I'll wrap this up by suggesting if you have any questions about conserving cash in a 401k plan or a ESOP, to please discuss with your admin specialist. Thank you very much, and I'll now hand this over to Renee.
Thanks, Gary. I'll just discuss a couple extra things that you might be able to do to conserve cash for your ESOP, in addition to the things Kevin already talked about in regards to your distribution policy. Of course, those are some big things that could change and help you conserve cash. But there's other few things you might want to consider. The first here listed is that you may want to take a look if you have segregation of terminated participants in your plan. You might want to take a look at the language and how that's written. You may be able to amend that plan language to maybe either take it out or change it somewhat. I know we've seen some language is written in a way that you may be able to not have segregation in it. It may have the word may in it. It may say something like if cash is available, and if there is no cash available, maybe you would not have to segregate. So again, that's something you'd want to look over carefully and talk to your administration and probably your legal counsel about to see if that is an opportunity for you. The second item is in regards to if you already have cash within your plan, and maybe some plans that, for example, are partial S corporations have a lot of S distributions flowing into their plan and therefore have some healthy cash balances within the plan. You may want to consider paying some plan expenses directly out of the plan versus having the plan sponsor pay them. Some examples of items that you could pay out of the plan would be your annual record keeping fees, your trustee fees, distribution processing fees, audit fees, valuation fees, those sort of things. So that might be something to consider. One item though that you do want to be careful with if you haven't done this in the past is to also take a look at your plan language and what the method is for allocating those expenses. Some plans are written that allocation will be based on the cash balance within the plan or other investment in the plan and not the stock. And if you've been also segregating, that can mean all of the cash is in the accounts of terminated participants. And so if you ended up taking out all of those kind of fees out of only their accounts and not everyone's accounts, that probably is not a fair thing and may seem somewhat discriminatory. So you would want to take a look at that and check the wording in your document. In those cases, we recommend a lot of times that instead of doing it on cash balance, you do it on total account balance. That way everybody is paying their portion of those fees. The final thing Scott already mentioned briefly is there is a chance you could possibly do some ESOP loan modifications or forgiveness of debt. The DOL has issued guidance on loan modifications, and you can see that reference there in FAB 2002-01. That document does go over all the fiduciary considerations and obligations that are a part of making some type of loan modification and would help you to do something to avoid any kind of prohibited transactions. Of course, that is something you definitely want to get your ESOP counsel involved in helping you determine if that's even a possibility in your case, and if it is, obviously, to help you draft those documents. So I think that's all I have there, and we're going to turn it over to let Carla finish up by talking about some participant communications.
Okay, hi everyone. Thanks for joining us today. I just want to talk a little bit about your communications to employees, both for plan purposes and from a broader perspective.
Basically, overnight, our whole world, the way we live, the way we do business, has changed drastically, both from a physical aspect, with most people being kicked out of the office and working remotely, and from an emotional roller coaster. We've gone from a pretty healthy and thriving economic environment to one of shock, fear, shutdowns. Hearing assurance from you, the leaders of the company that these employees work for, can go a long way toward keeping your culture as healthy as possible and your employees engaged. So I know you've all got your own set of challenges, possibly dealing with a remote workforce for the very first time. In light of all this, your employees are certainly going to welcome any information that you give them about what the company and management team are doing to address the many challenges. Here's just a few tips when considering what and how to communicate to employees from a general perspective. Number one, try to have a clear, concise message across the entire company. Take the time to develop a list of things that you're actually doing to communicate those things to the employees. You might include things like specific ideas for preserving cash, as Gary and Renee were talking about, developing new sources of revenue, specific cost-cutting measures, renegotiating contracts and pulling lines of credit for emergency cash needs. Are you using or planning to use any of the new relief acts? And if you are, how does that affect the employees? Any measures that you are taking to stay in business and take care of your employees should probably be discussed with them. And on a positive note, many companies are being presented with really new, unique opportunities to fill new needs and sell new products and services that are arising out of all this. Let your employees hear about those things too. They bring hope. And in return, listen to any ideas that they may bring to the table. You really never, ever know where the next big idea might come from. So with all that said, plan carefully what your message is and expect to repeat it multiple times in multiple ways. This is all pretty complicated, as we know. Number two, remember that in these unprecedented times, it's possible that every employee may be impacted differently. Be flexible and open to making exceptions when possible, but remember, always make exceptions and adjustments outside of your qualified plan. The uniform and non-discriminatory rules of ERISA still apply. So for plan fiduciary precaution, try to communicate more from the boardroom and from leadership roles rather than as a plan fiduciary when possible. And finally, for ESOP companies, let your ESOP ambassadors and communication committees do a lot of the heavy lifting to help encourage employee owners to think like an owner. This is likely any owner's biggest challenge ever, to figure out how to navigate and come out better on the other side. One final tip about communications, especially in dealing with a mostly remote workforce: provide clear expectations as to how you're going to be communicating with them going forward. It's so important for you to address cybersecurity and be sure to let them know where reliable information will be coming from. Try to funnel most of your communications through a few secure channels so that employees are not tricked or questioning whether notifications and information are valid communications from you. Everyone's seeing more cyber scams these days. Specifically in communicating your plan needs, Blue Ridge is continuously enhancing ESOP Connection, our online communication system that's available to clients. So for those who engage those services, we want to engage the ESOP communication services. We want to encourage you to really use this resource to communicate with your employees about what's going on in your companies. Many of our clients have already posted COVID-19 notices and are using it to update employees frequently on the impact of the virus on the company and the workforce. There are several different ways to get these messages out to employees, and there's also a 24/7 Q&A feature for them to channel their questions that we know you're getting. You can also post videos as well as written content on your site so they can see your face. There's a lot of ways to use these tools. So if you have something that you want to post, just contact your ESOP Connection team rep or your administrator, and we'll get it on there for you. Finally, there's also a lot of really good free webinars and other educational online sessions out there right now. As Dolores mentioned, the ESOP Association and NCO are both producing really informative presentations specifically geared toward ESOP companies and other qualified plan issues. So we really recommend taking advantage of all these resources. So I think we're just about at the time, and I thank you for joining us today. Anyone got anything to add, or shall I turn it back to Randy?
Well, I'm going to take over from here anyhow, because we are going to open this up to questions and answers to the full panel. But I want to answer a couple of things here real quick. That I know we scheduled this for an hour, so if you have to leave us, you know, I hope you got some great information from this webinar. As I mentioned, we are going to stick around to answer questions that you may have, and I have been recording questions that we've been asked during the that have been asked on the Q&A slides that I will now present to our panelists so that they can answer in more detail. But one of the big questions I got was regarding the recording and whether we will provide copies of these slides, and we will. I've been told it'll take at most a week to have the recording put together, but we will send them out the recording along with a copy of the slides for those of you that want them. But when I say those of you that want them, we're going to send them out to everybody just in case there are some clients that were not able to partake in this webinar. If you do have some additional questions you want to ask during this time because we're not able to unmute all of these lines, please type them in the question and answers, and I will do my best to provide them to our panelists. If we do run out of time, we will put together a Q&A and type out answers to the questions that weren't answered. So with that being said, I'm going to go ahead and start asking questions, but please, you know, feel free to type in additional questions as we go through with this. So what I have here are the first set of questions, and they're going to be kind of in order as we went through the presentation, so bear with me. The first question I have here is, our ESOP does not allow loans. Does the in-service distribution apply to vested employees? So I will pass. I think this is a Gary question.
Okay, that's a very, very good question. So again, I'd like to remind everyone that the CARES Act does not change current provisions in your plan. If there are no loans in your current plan document, you are not required to add loans because they are now allowed under the CARES Act. You are not required, and there's also the special distribution provisions. You are not required to add those either. So again, nothing changes your current plan document. And that's why I mentioned earlier, it might be easier to manage some of the special provisions if you have a 401k plan. There is a little more adaptability, a little more access. Any amendments that are required are perhaps easier to do. So hopefully that answers the questions. It doesn't change anything, but if you do want to implement those changes within the ESOP, it does require an amendment. There is some coordination. You need to talk to your ESOP plan admin. So hopefully
Okay.
that helps.
Okay, and this is Dolores. I'll just add that we have had, I think, 2 ESOP plan sponsors talk to us about possibly voluntarily permitting COVID distributions from their plans. These are plans that already have significant cash balances in the plan. And in some cases, a plan sponsor might say, hey, for qualifying individuals, I would really like to offer a COVID distribution of up to, say, $25,000 or $30,000. The plan could be amended to provide for that. Again, we don't think we'll see much done along these lines, but we have actually talked to a couple companies that are thinking about doing this.
Okay, the next question I have is, in particular, I believe deals with the whole classifying of participants due to COVID purposes. are commission-only employees eligible to apply for hardship loans under the financial impact, indicating that they anticipate lost earnings due to the COVID-19 issues because they're commission-only. Business still open, and they are not positive or they're not tested positive or under quarantine.
Okay, I'll take that one again. So that falls within the spectrum of a qualified individual, and if there's adverse financial situations due to a furlough, layoff, quarantine, reduction in work hours, or the close or reduction of a business related to COVID-19, that could define a qualified individual. It would not matter if they're salaried, commission, combination of both. We're talking about an eligible employee in this particular situation. And again, where the plan has adopted those provisions.
So in this case, we're talking about maybe not necessarily a reduction in work hours, but a reduction in ability to earn commission?
That's what I believe the question was. Basically, they're commissioned, and so the anticipation is that their sales aren't going to be as they were in prior years, so they're going to be bringing home less income because of that.
Yeah, that would appear to fall under.
They aren't considered quarantine, and they haven't been laid off, and the company's still functioning.
Right, but that could be adverse financial situation due to COVID. It could fall under that definition.
Okay. The next one I know is a Gary question. For the loan repayment extensions, are we talking only new participant loans, or do they apply to loans that are already or previously put into place with this new law?
Okay, that's all loan payments.
Referring to the 1230 extensions.
Right, so that's all loan payments that are due in 2020. So existing loans, as well as new loans, are going to fall under this new rule. So if there is an existing loan and if the plan adopts these procedures, then if the participant is in year 4 of their loan and if they're a qualified individual, they can request the suspension of the payments.
Okay. This is, I'm sure, I think it's been covered before, but I do think that a lot of people are asking about this. The question is companies are not required to allow COVID-related ESOP distributions, correct?
Correct.
All right.
There's no requirement to permit these. No requirement, it's an option.
In any plan.
Right, in any plan.
Okay. For 401k's changes, what requirements do the employer plan sponsor have to notify the employee plan participants about these new temporary provisions?
Okay, that's a Gary question. Okay, so that could vary, and I had mentioned earlier that each of the platform providers perhaps have different procedures in place, may provide access to information, may have template notices. Let's assume that that some or all these provisions are to be adopted. If your platform provider does not provide any sample communications or other methods to notify participants, let us know. We could help you to put together a quick memo or notification that you could get out to employees. But again, the answer is going to vary depending on each plan, but we could help.
Okay. Next is going to deal with partial plan terminations. How are the rules affected if layoffs occur in 2 or more waves? So the first wave does not reduce staff count by 20%, but later a second wave, when you add them together, does. And I think this is a little more than just the COVID. I think this is in general.
Right, right. I think that would be more in general. Well, yeah, I think that starts to get a little tricky because, I mean, in general, when we're looking at whether a partial plan termination occurs, generally speaking, we look at it from a plan year perspective. However, if the conditions that could have caused a partial plan termination can go across a period that exceeds a specific plan year. So if wave number 1 doesn't trigger a partial plan termination, but that second wave does, and it's all considered to be part of that same event, I think you probably could make an argument that if that second wave pushes you over the 20% threshold, that could trigger a partial plan termination. Now that's going to be difficult, for us to identify independently without you letting us know that these waves have occurred, since generally speaking with our ESOP base, we're doing these determinations on an annual basis. So if the waves go over more than one plan year, it may not be easily identifiable. So it'd be important that if that's something like that happens, that you're discussing it with your contact and with your ESOP counsel as well, to make sure that if they're all related terminations just over multiple waves, that's taken into account to make sure that you're properly vesting employees.
Right. Okay, Scott, here's a follow-up for you. When you're doing partial plan term, you are looking at those employees who were let go based on the company laying somebody off or furlough and so on and so forth. But what happens to those participants who voluntarily leave? Are they included in the partial plan termination?
Okay, so I think the answer is maybe. For the determination of whether or not a partial plan termination occurs, so when we're calculating whether or not 20% or more of your employee population terminated, that 20% calculation is just looking at involuntary terminations. So any employees who just voluntarily decide to leave and go work for a different place for whatever reason, anyone like that would not be taken into account for determining whether or not a partial plan termination occurs. However, if the amount of total involuntary terminations is greater than 20%, so that a partial plan termination occurred, the people who are affected that have to be made fully vested would include those voluntary terminations. So you're not looking at those voluntary people for determining whether or not you hit 20%. But if you do, it does require then, for who's considered affected, does require you to fully vest every terminated participant, regardless of their reason for termination.
Okay, regarding the 404, the 25% employer contribution limit, does that include the DB plans as well, or is that strictly your defined contribution plans?
That'd be strictly defined contribution plans. There's separate limits that are, subject to companies that have defined contribution plans have additional separate deduction limits that kind of goes outside the scope of what we're covering here today. But if we're just specifically talking about the 25% limit, that really is intended to just look at defined contribution plans.
Okay. Next up is for Dolores, is kind of talking about the interim valuation date. We get our valuation in late May or June. Do we have to wait until getting that valuation to do an interim valuation, or can we have them done at the same time?
I think you could have them done at the same time. Again, if you're a 12/31 year end, your appraiser is going to want data that was based upon what was known at that date. And then for the interim valuation, data based upon what was known on that date. But if there's no reason for me to believe that they couldn't be done at the same time if they're not done already.
Okay. Another that was popular question that came through was, are we required to do an interim valuation? because of this, or can we just continue using our 12/31 valuation?
Again, there's no requirement. Again, I think a fiduciary is going to consider whether one is warranted or not. So again, if my share price went down 50% and I ignored the question, that's probably not a very good action for a fiduciary to take. But again, the decision to have an interim valuation is based upon a review of the expected impact of a share price, the duration decrease, the duration of that decrease, and trying to be fair to all participants. So I don't know that there's a requirement, but I think there is something of an obligation to at least consider whether an interim valuation is appropriate.
So I do know there was a question group that says, does this mean you will do both the 12/31/19 appraisal and, for example, 4/30? As Dolores just mentioned, it's not required, but it's possible. That's the interim date you pick. Do you want to talk about picking an interim date, or just kind of leave it as, if you decide to do an interim evaluation, then the date you pick should be close to when you're going to do your distributions, or do you have some other advice to that?
Well, I think, if you've got time, it should be a date at which you feel good about being able to develop projections of future earnings. But I think the setting of the date, it would be good to talk to your valuation experts first before you establish the actual date.
If you do an interim valuation date, does your normal end of year date apply to future valuations?
Yes, I mean, your plan says my plan will be valued generally as of the last day of the plan year. And so that stays in place. I'm still valuing my plan as of what the plan defines as my valuation date. The interim valuation is just an additional valuation date.
Okay. If our company got a PPE loan that is forgiven, would that be ignored for my current year evaluation?
I think that's beyond the scope of my knowledge, since I don't do valuation work.
Right. I would think that's a question you would want to ask your valuation firm on, because I do agree. I don't know if we would have the ability to answer that one correctly.
Yeah, right.
We did have a question come up about paying plan operation expenses out of the ESOP when you don't have cash available. I do believe, and correct me if I'm wrong, that during the conversation it was, if you have cash balances in your ESOP, then it's a possibility of doing so. The only way to do it without any cash is by putting cash into the plan, but you might run into other issues by, contributing additional funds to be able to do that. Does anybody want to elaborate further on that?
Right. This is Renee. Yeah, it was meaning if there is already cash in the plan, because if you had to put cash in the plan, you're obviously not conserving cash. So it would only be in the instance where you already have some cash balances.
Okay. For any of you on the panel here, what relief are you expecting in the next stimulus or DOL or IRS guidance for ESOPs due to COVID financial issues, especially with regards to distributions and diversifications? Are you hearing of anything new that could come out in the next stimulus package, which I know is being talked about?
Well, we know the ESOP Association has presented a number of proposals to people in Congress and to regulatory agencies. We have no idea whether any of these proposals will be acted on. One thing we would certainly like to see would be additional time to file the Form 5500. I think that one may be doable. The other thing that we potentially talked about with the ESOP Association is trying to encourage the IRS and the Department of Labor to cut back on their investigation activity give people a break to deal with their current situations. But so far, nothing there. I keep hearing the DOL is still investigating away, but at least the ESOP Association has asked if some of that activity could be curtailed in the interest of giving people time to deal with the current issues that are on their plate. And then we've certainly asked whether a plan could be considered not at fault if it paid distributions and diversifications right before the very end of the plan year, even if the diversification payment should have been made earlier. Again, whether we get any relief there or not is totally unknown. That's probably one that's a lot less likely. But those are some of the things that have been proposed.
Okay. This is a question for all of you. You know, from your experience in working with your clients, are you seeing ESOPs ask about plan terminations due to layoffs and financial distress? So we're talking about terminating the plan itself.
I think luckily I think I've only talked to one so far that's discussed a plan termination, but I think their business had already experienced difficulties and employee shrinkage before COVID-19 came along. So this was kind of the icing on the cake for them. But I think, again, most people are trying to find a way to stay in business and conserve cash and explore other avenues for new business. And ESOP companies have a way of doing that, finding ways to endure and finding ways to endure better than their competitors who are not ESOP companies. And I expect a lot of that same thing this time.
With regards to RMDs, who is it that makes the election to waive the 2020 RMDs? Is it the plan sponsor or is it the participant?
Okay, another good question, and this is something we need more guidance on. Keep in mind that the CARES Act was written very quickly. We don't have all the details. The way we're reading it is that all RMDs are waived for 2020. That's at plan level. So if a participant who would normally be entitled to a 2020 RMD wants to take that distribution, if the plan does allow for it, if the IRS gives us further guidance, and we're talking about an RMD, an amount that would otherwise be an RMD taken after March 27th, then that amount would become an eligible rollover distribution. But as far as the waiver of the required RMD, that's at plan level, to our understanding.
Right.
So we're looking at the
We
plan
do think there
sponsors
will
on
be
making that election.
some. Yeah, it's really the plan sponsor is going to decide. I've got some people that want this RMD amount anyway. They were counting on it. So there should be room for them to provide for those amounts to be paid through any amendment that's drafted later on to cover the CARES Act. It's just that you would have to tell these people, well, okay, we're going to pay you this RMD, but this amount is now technically eligible for rollover.
Okay. Question came in about diversification language. Can they amend to conserve cash in the short term? So, for example, instead of saying being a maximum of 25%, they can leave it to 15%.
I'm not aware that they can adjust the 20% to 15%. I think that's got to stay at 25%. Now, you may have a plan that may have some more liberal diversification provisions, and there's a possibility you could maybe scale those back, but I don't think that the IRS is going to change the 25% limit.
Okay. I've got two questions that kind of relate to interim valuations again. The first one is, if you've done an interim valuation in the past, do you have to use that same date for this interim valuation for the current year?
No, again, that date could be set as a different date. Again, you can have different triggering events that occur in your business at different times that can cause a significant change in asset values. So yes, if just because you picked a different date 5 years ago doesn't mean you picked the same date today.
Right. And if you do an interim valuation, is this valuation now good until the evaluation is the end of the year?
Yes, unless you have another interim valuation, that valuation should be good until your next required valuation date.
All right. I was wondering if this kind of comes into play. Let's say you decide to redeem shares in your ESOP so that you can help pay out distributions and things. Would you have to get another interim valuation for that redemption date, or could you rely on the one you got prior?
If you're doing a stock distribution, you can rely on the prior valuation. If you're doing a stock redemption from the plan where the company is buying shares from the plan, then you need an updated valuation as of the day of that transaction. But we encourage clients to do stock distributions, so you don't need that updated stock valuation.
Okay. On partial plan terminations, do participants who've been with you for 1 or 2 years but are not vested count? Or what about participants that have been with you for less than a year? And I know that I think the question used employees, but I think we're talking about participants because in partial plan terms, that's who we're looking at, correct?
Right. Yeah, that's correct. We're looking at participants. So the whole analysis on whether or not you have a partial plan termination is looking at whether 20% or greater of your participants terminated employment for involuntary reason. So that would count those folks who maybe only recently joined the plan, maybe have an account balance or not vested in it at all. They are a participant, and so they would become fully vested in their account balances. So those folks who maybe only have a year or two's worth of participation would be considered in that analysis.
Okay. Can you give an example of an ESOP loan forgiveness in relation to the DOL FAB 2002 and how it's structured?
I think the Field Assistance Bulletin 2002 really talks more about actual refinancing of the loan, like in terms of length and interest payments. It doesn't really go into so much of the forgiveness of debt. Other than, I guess, you know, if you're refinancing and are trying to lower the amount, but it doesn't really talk about that in that Field Assistance Bulletin. If you were going to forgive a payment and maybe extend the loan, that might fall into that. I don't know if anybody has anything else on that one.
Nope. Okay. Can we pre-fund our 2020 ESOP contribution during the 8-week PPP forgiveness period to have it qualify for forgiveness?
I think we're talking about the payment protection program, and I think we're still trying to get our arms around what are qualifying retirement benefits paid during this period. And what does that mean? And I'm not sure we're going to have the answer there at this time. We're waiting for more guidance too. So I know that the payroll costs, under the payroll costs for that program, that includes employee benefits, including payment of any retirement benefits. Now we know we've seen some guidance that says, well, if I'm paying matching contributions each pay period, that should come under what is included in these payroll costs for this program, the Paycheck Protection Program. But I've also seen a question as to, you know, making a discretionary year-end contribution, does that really qualify as something that includes a payment of a retirement benefit? That one's not as clear. So I think we're still waiting for a little bit more information here on what falls under payment of any retirement benefit for inclusion in payroll costs.
Okay. Following up on the waiving of RMDs, is a plan amendment needed to waive the RMD, or is it understood and it's just waived for 2020?
The answer is yes, there is an amendment required, fortunately. We have until the end of 2022 to have those amendments prepared and executed. Any changes because of the CARES Act will be captured in those amendments, and perhaps guidance we'll get in version 4 of the stimulus package will expand on the amendments needed and help plans in additional ways. So yes, so the answer is everything is in the amendment.
Okay. If our plan year ends on May 2020 and we furloughed more than 20% due to COVID, what happens if the furloughed employees are not brought back by the end of the plan year? Scott?
Okay. Yes. So if you've got, right, so if you have furloughed employees and they're not brought back by the end of the plan year, it would seem to me, unless anybody disagrees, that either if you have a greater than 20% involuntary termination, and I guess it depends on how you define a furlough, right? I mean, are those employees really considered as though they were separated from service? You know, have they terminated employment where you've entered them in your payroll system with a termination date and shut off benefits and done all of those items that would truly be considered a separation of service? I think if you have in a group of employees who were, you know, truly separated from service, and it's greater than 20% of your population, and that happened within your plan year, at that plan year end, if those employees haven't been brought back yet, at first blush, it would seem like that would trigger a partial plan termination. Now, if you know that 2 months later, you've rehired half or all those employees back, then that may be further information to share with us. Or share with your ESOP counsel to make a separate determination on whether or not those subsequent events affect whether a partial plan termination occurred. That's probably not a black and white answer, but I think in that type of situation, the further analysis on whether those employees came back in a short period of time is something we'd want to know and discuss.
The one thing I want to point about partial plan terminations, though, is the fact that if a participant does leave due to and is 100% vested due to partial plan termination and later comes back, that 100% vesting only applies to those prior balances. Any new contributions that participant may receive, assuming they weren't already have enough years of service for full vesting, would still go under the vesting schedule. That those new don't automatically become 100% vested as well. And then I have a comment here. It says deadline for forgiveness payments is June 30th. So I wanted to make sure that I pointed that out. At this time, that is the last question or comment that I have in the question and answers. If there are any more questions, please type them in now. And if you do not or did not have the ability to ask a question during this, please reach out to your plan administrator and we'll do our best to get back to you with an answer. A lot of this right now is kind of a moving picture. There's still some gray areas because we are looking for additional guidance. And as we get the additional guidance, we will definitely reach out to all of our clients through updates in a newsletter or a email blast, so kind of keep that in mind. I just did get another question. Annual data provided to Blue Ridge provides a termination date, but does not include a reason for termination. Going forward, should we be giving Blue Ridge a reason for termination? And I know where this is coming from with regards to partial plan terms, but would anybody on the panel like to address that or answer it?
I mean, I think it's a good idea. You know, if it's not, you know, cumbersome, you know, that's something that you're tracking within your system and is easy to report to us. I mean, we haven't made any internal determinations to change our standard census template package to formally request that from all of our clients, simply because historically the process has been, if it looks like you have high turnover, that's what prompts your contact to reach out to you and ask whether or not the potential impacted group of people have terminated for voluntary and involuntary reasons or not. But if you have that easily available and are able to add that to the report, then that just provides us with that information sooner, so we have less back and forth to make that determination.
As we're doing your partial plan terminations, if we do find that you're at the 20% or higher, you will get an email from your administrator asking you to provide the reasons for termination. So whether you do it, I guess, with your as an update or an addition, an addendum to your census or not, just know that we're not just going to assume partial plan termination. We will follow up with you on that. At this point, I don't have any additional questions. I do want to thank all of our panelists for taking the time, but I also want to thank all of our clients who did take the time out to spend the hour and a half plus with us going over this. I know that there's going to be additional questions, and hopefully as we get additional clarifications from everything, we will definitely keep you posted. But if you do have questions going forward, please, as I mentioned earlier, reach out to your plan administrator, and we will do our best to get those answers to you. Since I do not see any additional questions coming through, I think I'm going to go ahead and end this webinar. Once again, thank you for participating, and I hope everybody is staying safe and has a great day, and have a great rest of the week. Thank you.